Okay, so what I'm going to do is I'm going to go through basics, and if you'll stay tuned, okay, I'm going to teach you some additional tips and tricks along the way that's really going to unlock the spreads to you and make them make a lot more sense. Okay? Um, so right here, we're just doing a quick spread basic overview. Now that we got an idea of sort of where we're headed, we're trading on the Nadex exchange. Every product has a capped risk, meaning if you put up $150 in risk, that's the most you can lose on the trade. Put up $50, that's the most you can lose on the trade. Okay? So that risk or that margin, it's the same thing. You can't lose more than that. You still get insane leverage, like if you're directionally trading. You can trade the stock indices. You know, there's U.S. indices, there's international indices. You can trade future commodities. A commodity is something that if you drop it on your foot, it hurts. Corn, you know, if you bushel of corn, barrel of oil, okay, a whole bunch of gold bricks, you know, it'd be nice to drop on your foot, I guess. Then that's a commodity, okay? And forex pairs, that's foreign exchange. Like if you go, you know, if you're in the U.S., when I know we have a lot of international traders as well, but in the U.S., let's say you go to Canada, or let's just say you go down to Mexico and you know, swap out pesos for dollars, or you're bartering and they're like, well, $1, what does that $1 mean in pesos? And so you're doing foreign exchange, foreign currency, and that amount goes up and down in value. So how they work, you have a floor and a ceiling. The floor is the lower number, like 2,400, and the ceiling is the higher number, like 2,500. Okay? And they automatically set that number. It's always going to be the same width for that expiration. So they'll have like 2-hour expirations, and they'll have 6-hour, 7-hour, 8-hour, 23-hour expirations, just on different markets. And that width is always set. You don't choose it, you don't make it. Okay? It's just automatically there. And a very important point is there are spreads that are 100 wide, and there are spreads that are 1,000 ticks wide, which means they're not like binaries. They're not all or nothing payouts, okay? And they're not just $100. There are $1,000 ones like on oil. There are $500 ones. There are $30 ones. There's all different sizes of spreads. So why is it called a spread? Well, that's the difference between the floor and the ceiling, 2,400 and 2,500, okay? So if you subtract 1.2500 from 1.2400, that difference is 100 pips or ticks. Pips is the word used for Forex. Ticks is the word used for futures. I see a lot of traders say pips when they're talking about gold. That would be ticks, okay? It's not a big deal. It doesn't really matter. What it means is minimum increment move, okay? A pip is just something that's used on a currency because you have two different kinds of currency in one contract. Like you have pound and yen, okay? Whereas a tick is when it's the same currency, minimum tick. And a minimum tick in stock, if you're a stock trader, is 1 penny, right? So a cent is a tick in a stock. So where a tick or a pip may be a different value, it may be 1 penny, it may be 0.1, it may just be a solid whole integer number, it may be 0.0001, like over here. It doesn't really matter where the decimal is. It's the last increment the thing ticks in. So don't let yourself get caught up in where decimals are, okay? 2,400, 2,500, or 12,400, 12,500. Doesn't really matter where that decimal is. The last integer is the tick, okay? So it moves in pips or ticks. That's the last digit quoted. I don't know why this says 1 penny. Might want to correct that, John. So let me put that on there. I don't know. That's a typo. But so not a penny, but the last, you know, the 1, the 0 right here in this example. Each pip is worth $1. Okay? So there are 100 pips of value. Maximum value. Not the amount you have to pay, okay? But of maximum value. So if every pip is worth $1 and there's a 100 pip spread, meaning the difference between the floor and the ceiling, that's 100 pips. Okay? Does everybody get that? Are there any questions on just that basic thing right there? And if there are, it's okay. You need to ask them because it's only going to go faster, and this is the basic building block. And the worst thing you can do is not say something if you're lost. If you're like, well, I'll get it later. Well, then you're going to feel like you have to watch this 25 times. I don't want that. So if you're stuck here, let me know. Okay? If you're stuck at any point, let me know. All right. Now, if you're selling a spread, now we can sell first and we can buy first. That confuses a lot of people that are newer to trading. An example for you, that I've used a couple times this week with people that have asked about, how do you sell something you don't own, and what is that? What do you mean you sell first? And has there been a movie or a video game or something like that that you've wanted it's not out yet, but you want it like the first day it comes out? Okay, so you pre-order it. What happens is like Walmart or GameStop or somebody like that sells it to you first. Say they sell the movie to you for $20, okay? And they buy it from whoever the supplier is. When it shows up, not before, but when it shows up, and let's say they pay $10 for it, they make the difference. They sold first at 20, they bought back at 10, they made $10. They sold first, bought second. Okay? So, or maybe somebody went out and they, have an ice cream truck and they went and bought a bunch of ice cream bars, whatever. They went around, it came up, they sold them the ice cream at a higher price. They bought first and they sold second and made the difference. It doesn't matter what order you buy or sell in, because you're going to do both. You're going to buy and then you're going to sell. You're going to sell, then you're going to buy back. If what the difference of that is your profit. It doesn't matter what order it's in, just as so long as ideally you sell higher than you buy back. Okay? Does everybody have that down? All right, so you got to let me know just to make sure that we're all on the same page. Okay? All right, we're good. All right. So, and our Iron Condor over here is doing good. Our hedge is sort of worthless. We gave up a little bit of money for some insurance, but, most of y'all probably pay insurance for your house in case it burns down, or your car in case you get in a wreck, right? So, because the value is there. So, I'm okay with giving up, $100 or so in order to, collect, going for, $600 on the trade. All right. So, just keeping you updated as we go. So, if every pip or tick or whatever you want to call it is worth $1, and I sell first, I can't lose any money above the ceiling. This is one of the beautiful things. You get like this massive leverage here. I cannot lose any additional money above the ceiling. I can't make any additional money below the floor. So if I sell at $24.90 and the ceiling is $2,500, the difference between those two numbers is what? $2,500 minus $24.90 is, this is an interactive webinar, so make sure you answer. Gotta get your gold stars. There you go. Okay. All right, so we got 10. All right. 10 pips. So my risk is how much? If every pip is worth $1 on Nadex, so whatever that minimum increment size is, it's a $10 risk. And this would be basically equal to controlling 12,500 US dollars, by the way. Okay? And you only have to put up $10 to do it. If you did this on the euro, like on Spot FX, you'd be putting up a couple $100. Now, this obviously was a while ago because euro's a lot lower now. But still, you'd put up a couple $100, and you'd be risking, plus your risk will go up and down. Your risk will never exceed $10. You're only putting up $10 to go 12,500. So that's pretty fantastic in my book. Okay? Now, how much could I make? If the market went all the way down to the floor, and let's say it expired down here, what's the most I can make on this trade? If I sold at $24.90 and I can't make any additional money below $2,400, so Harold, good job. So $90. All right. Yes. All right. There we go. My feed. Yes, exactly. So $90. Okay. If I'm buying, I can't make any additional money above the ceiling. Can't lose any additional money below the floor. Right. So I can't get stopped out of the trade per se in this case if I was holding on to it. Buy it at $24.10. What's my risk on that trade? On just one Nadex spread. So if I bought at $24.10, I can't lose anything below $2,400. Risk is $10. Exactly, Benjamin. You got it. So got 10 pips, $10 risk. Every pip's worth $1. $10. How much can I make on the trade? What's the most I can make? $90. Okay, so $90 is the most I can make on the trade. Now, and that's because it can't make any above 2,500. 2,500 minus 2,410, where I bought at, is 90 pips. Okay? So I can close it at any time. I can sell here, buy here, sell there, sell here, buy here, sell there. Okay. Anywhere I want to. I can open and close it. I'm not stuck. It doesn't have to expire in the box. It could be above it. I'd make maximum profit if I bought it. It could be below it. I'd have maximum profit if I sold. If I bought it and it expired outside the box, I'd have maximum loss. Okay? So if the spread expires at the settlement price at the time of expiration, then let's say I bought at 24.10, and let's say it expired at 24.80. What would I make on the trade? If I bought at 24.10, it expired at 24.80. What would I make on the trade? $70 pips. Very good. Awesome. Okay, yeah. So now we got more of you that answer, the better. So that means you're going to be getting this down a lot better than everybody else. So good job. Okay, now expirations. I want to go through one more thing on here, just a little bit more practice. If I bought at 24.10 and I sold at 24.50, what would I make? $40 pips. If I bought at 24.10 and I got out at 24.05, what would I make? Or lose? -5. If I bought at 24.10 and it expired at 24.09, what would I make or lose? 1. Okay. Keep this in your mind, okay? A lot of you trade binaries, and 1 pip makes all the difference, right? 1/10 of a pip or tick can make all of the difference in winning or losing. If this thing, this big iron condor I got on over here, okay? It's not the biggest one we put on this week, but it's a pretty decent sized one. If it did expire outside of my break-even zone by 1 tick, how much would I lose? $1. Okay, just a single dollar on the trade, okay? Not $80. Okay? So again, not $80. What if I did a 1-to-1 risk reward? 60 for 60, okay? That'll be pretty easy to manage too, right? Because it's only $1 a tick. So if I go over here, and I just really want y'all to hopefully start to grasp this, because once you grasp it, you're like, why am I doing premium collection on binaries? Which I still do that, okay? But this is just relaxing. Okay, if this is my break even, and I can make 120 pips, 12 points below here. So let's say 44.77 is my break even. Now, not including the binaries. Okay, now I'd actually make money all the way down to here. But let's just say that was my break even. I don't have the binary hedge on. And I got 12, I can make, 12 points or 120 ticks or $120 on the trade. In this case, on NASDAQ. Well, I can go down here to 68 and then down to 66. Right down here before I've had a 1-to-1 risk reward on it. Okay? So I go 12 points below here. Pretty good distance below this point. And at this point right here, now I'm at 1-to-1 risk reward. I'm outside of even the expected move on the trade. Okay? And I had a 1-to-1 risk reward on the trade. That's a big, wide condor. And past that, guess what? I'm still at $1. So instead of risking 80 to make 20, that would be like risking 120 to make 120. And it has to go way, way, way against me to even lose that. So my 1-to-1 gets really wide. Now, having this binary on, I'm 12 points below that. Now I'd have to go down here to, around 56 or so before I would even be at that original 1-to-1. So we'd have to have a pretty big move for that to happen. Okay? And as you can see, it's staying right around there. We got that low volume, which is great. Staying right around 44.90, which is our middle strike. Okay, our ceiling on this one, our floor on this one, and we're just collecting that time decay as it passes by. Okay, I got 5 minutes left on the trade. Okay? So going pretty well. Now, intraday can do as little as 2 hours, can do 22 hours and 15 minutes. So they can, they can be very short time frames. Now you can hop in an hour before, 30 minutes before, 10 minutes before, but they have 2-hour expirations and they have up to 22 hours and 15-minute expirations. Okay. The longer the time frame, the wider the spread, the ceiling is going to be, the floor and the ceiling. Okay. They have expirations. They got settlement. So you got days of expiration. You got time of expiration. It's always Eastern time, by the way. Okay. Always Eastern time. Now, the width we already talked about is between the floor and the ceiling. And number of contracts is the number of spreads per expiration per range. So there'll be usually 3 And there's also like what's known as a master spread, a really wide spread. So that's why when you're looking on Nadex, if you go over here and I pull up one of these contracts, like if I go to indices, spreads, and I choose US Tech, and I choose, the 415s, you'll see 3 of them. If I choose the daily, you'll see 4 because they have a really, really wide one in there. Okay? And that is which one is that? It's even harder. It's hard to tell on here. On our scanner, it's a lot easier to tell. Here. We'll use our scanner. And then we'll go to spreads. And then we'll go over here and find the wide one. There it is. 4450 to 4430 because we have width. 800 pips right there. Okay? So that's the really wide spread. Again, that was the 4450 to 4530. It's at the bottom. So that should make it pretty easy. But there's 3 spreads plus the master spread on the daily. But every other time you're going to see 3 spreads. Okay? Why are you going to see 3? Because they're going to have a spread that is going to be from where the market's at right before it opens. Okay? Up a set amount of pips. So this is like a euro dollar example. So 250 pips up. Okay? And then it's going 250 pips down. Okay, this is like on a 7-hour spread right here. 250 pips down. So we got 3,000 to 3,250. That's one spread, the upper spread. We got 3,000 to 2,750. That's the lower spread. And then we got 2,875 to 3,125. That's the middle spread. So they'll basically put it, in equal distance, like 125 pips, 125 pips below, above and below. Okay? If we use this on our current live NASDAQ example, okay, what do we have over here? We got 44.90. Okay, all the way up to 45.30. We got 44.90 all the way down to 44.50. And then we got 44.70 to 45.10 right in the middle of those two. Okay? So that's sort of like looking at, this right here. And that right there. Okay? So we got the upper spread, the lower spread, and the middle spread. And then, on a 2-hour contract, see, it's like 100 pips wide here on the euro dollar. So 3,000 to 3,100, 3,000 to 2,900, 2,950 to 3,050. So it's 50 pips above and 50 pips below. That's where those strikes come from. And again, the widths are always the same. So they're defined on the contract specs page on Nadex. You can find the link to that inside the scanner also. Okay? All right. So that's where those come from. You got floor, you got ceiling, right? You got buy, you got sell. That's where you buy and you sell is the amount you make or lose. You got capped risk and capped reward. You got $1 per ticker pip. Okay? So those basics are really easy. And what I'm doing is I'm going to do one more video where I go in and I talk about the spreads and I talk about how they work specifically with all the things that get everybody really confused. Okay? But one thing I want to do, since we are coming up on expiration now. Okay, so contracts I put on are about to expire. And then in a moment, we're going to get the settlement email. Okay. So as you can see, these are closing out. We got our open positions. They got to settle out here. It takes a little bit longer than a day, but they'll settle out. And then I'll get an email that'll come to me. And we'll look at what the payout was. And then as we keep moving into the next video, so it's going to be a part 1 and a part 2, I'm going to go into how the trade actually worked out. So let's see here. We're just going to wait for just a moment for Nadex to send me the settlement email. So again, one of the statements was by Gary, is like, hey, these are really easy to trade on your mobile because they don't move as fast. They're simple. So yeah. Do all the spreads have the same bid and offer? No, they do not. And that's the big piece that messes people up. They don't understand where that bid and offer comes from. That's what we're going to cover in the next video. Okay? And once you get that, then you're going to be like, oh. It's just all of a sudden going to make a lot more sense. Question was, do you close out one leg when it hits max profit? I usually do it when you're not really going to hit max profit because nobody's going to buy from you when there's nothing to make, right? So if I sold, I'm not going to be able to buy back at the floor because there's not going to be anybody there who wants to sell to me for zero profit potential. So I will most often put in, on this one I just didn't because just how it was trading out, I wasn't worried about it, but you can go in and I'll put it in usually like half a tick off of the floor or the ceiling, half a point. So on NASDAQ specifically, so I'd put it like, since when I say half, I mean zero point 0.5. So I'll put it like 0.5 above, 0.5 below because the U.S. Tech 100 spreads tick in single digits of 0.1. Okay? So I'll usually either do 0.5 or I'll do like maybe 1 point. So I'll give up like $5 or $10 to close them out. So, yeah, nobody's going to buy from you when there's nothing to buy for. Okay? So like, that's one thing you guys really got to think about. You know, like, why would somebody take the other side of my trade? Okay? Nobody's going to buy from you when there's like $1 left in the spread. Their fee alone would exceed any profit potential they have. Okay? Would you take that trade for any reason at all? Like, even if it was guaranteed, would you take it? No, because it'd be a guaranteed loss. Okay? So, because, I mean, if you have a $1.80 round turn, you can only make $1, you're going to lose 80 cents no matter what if you do that trade. Okay? So, yeah, definitely think about that. Don't be putting, like, these $1 buybacks and quarter buybacks and $99 sells on binaries. And, you know, I mean, you got to put more than the bid offer spread in there. Okay? And usually a couple ticks on top of that. Also, you'll see your size will go way down when there's no bid offer spread. So I look at it, and if the bid offer spread is 1 or if it's 15, I don't care, whatever it is, okay? I'm going to make sure that my buyback at the lowest or highest, whatever, you know, whichever way you're going there, is going to be at least the bid offer spread off of the floor or ceiling, plus a few ticks, okay? Okay, so and then another question, just doing some Q&A here at the end before we go into round 2 on the video here. If we take enough money from the market maker through iron condors, you're not necessarily taking it from the market maker. So the market maker, remember, they are trying to make bid offer spread. So when you're buying, they're selling. They're looking to unload that contract to somebody else, hedge it off, either whether it be in the options market or the futures market through what's called, I'm not going to get into it, but through the futures market, the options market, the forex market, or to other traders. They're looking to hedge off. You're not taking it from the market maker, okay? Now, if they don't hedge off, that's their own fault. A market maker's job, a liquidity provider, a real market maker, okay? A liquidity provider's job is to provide liquidity in the market, putting up contracts, and their goal is to make money off bid offer spread when doing so, not to take a position against you. So it's not like a bucket shop where you're trading against them, okay? They really do want to unload the trades. Let's see here. So, the question is, the spirit of the question is, if we made so much money on iron condors that, you know, we're taking all their money, which again, we're not, they don't care. Do you think they would eventually lower the premium on the spreads? Well, if they do, then that's great, because then they'll make arbitrage against other option markets, binary markets. They'll make them too cheap, and then they'll make basically spreads really, really, really cheap. So you can do you can make trades going the other direction. I mean, if this was really cheap, I mean, we had plenty of oscillations going up and down 3, 4, 5 points. So if they made the premium way too cheap, I'd just hop in there, I'd do a straddle on it, and I'd make money as it popped up and take profit. Come back down, do it again, just rinse and repeat. So this isn't about them changing their premiums so you can't make any money. Okay? If they change their premiums, either they create arbitrage or they create your ability to make money going the other way, and instead of selling it, you buy it. So you don't, the fear of the market maker is going to change everything if I trade it is not really how the market works. You bet. I mean, it makes sense that anybody would have that concern. So it's not an invalid concern. I don't want to make it come across like I'm saying that. I'm just saying it's just not a concern that you need to have. Okay, so we got our payout on these 2 trades. Okay. So I got 1,400 on one. Oh, that's the binary. I don't care about the binary. And that was my insurance. Where's my other spread? Okay. Sort of like, you pay for house insurance. It didn't burn down. You're okay with the payment.